Central banks and governments enacted massive amounts of stimulus in response to the COVID-19 pandemic. But the economy is now restarting, and year-over-year consumer prices in May increased 5%. So is this increase in prices temporary, or will we see higher and more sustained levels of inflation? The 5% year-over-year increase in consumer prices in May was the fastest increase since the summer of 2008. A combination of resurging demand and supply constraints has led to price increases in everything from ride shares to lumber to used cars. Another trend is deglobalization. Companies are moving their production back closer to home. Doing so increases production and labor costs, which in turn could be passed on to consumers. On the other hand, the recent increase in inflation could prove to be a short-term phenomenon. And longer term, the innovations in technology and across sectors could mean increases in productivity and really limit any material increases in inflation. The bottom line is that whether inflation remains more subdued or starts to increase from here, inflation is a silent threat to our investment portfolios. Investors should have a flexible and dynamic approach to thinking about how to guard their portfolios against rising inflation. This may include owning TIPS, or Treasury Inflation Protected Securities, or commodities, particularly those that are benefiting from the transition to more climate-friendly policies. Of course, over the long term, equities have proven to be the best way to outperform inflation, but in the short term, certain companies and sectors that have pricing power may prove very valuable.